Hello, everyone. Knox Ridley here, portfolio manager with the IO Fund. And this is our weekly broad market check. And just a quick recap, we've been really tracking over the last few weeks the divergences that we're seeing in the market. In other words, we're seeing some tech stocks weak, while other value stocks and global markets look relatively strong and look like they're ready to break out to push a little higher. And when you see these divergences, it usually occurs around major turning points, right? In order for the S&P 500 to just break down to 3,200 or lower, we really need to see all these markets working in unison, and we're just not seeing that right now. And so I just keep that in the back of your mind as we move forward. All of that information shows up within the price of the S&P 500, and it builds a pattern off the low. And the most bullish pattern, the one that we want to see, is a five-wave move off the low. When we see five waves off of a major low, that's telling you it's an early warning sign that a new bull market is forming. And that's what we were tracking. If you can take a look at this market, we've been tracking this kind of 1, 2, 3, 4, 5-wave pattern. And what we needed to see happen was this retrace, which we were expecting to hold this 3712 level. And the reason why that is, these five-wave patterns must meet very strict parameters. And one of those parameters is this fourth wave cannot go into first wave territory, which starts at 3112. And as you can see, we did. And so what that means is this five-wave move off the low, that got invalidated, which definitely complicates things. When you have a five-wave move, it's usually pretty easy to track, easy to target, and pretty easy to risk manage around, and lets you get ahead of sentiment before it shifts in the bullish direction, which you really want to have happen. So that doesn't mean that this bounce is completely over. In fact, with all those divergences I was talking about, which I'll get into a little bit more later, I think it supports a continued push higher. And so as long as this volatility that we're seeing holds 3640 on the S&P 500, the odd favors that. And these are the two counts that I see potentially happening. This is the most conservative and the one that we have as our primary as of now. And that is that the bear market up until October 13th was the first leg in a much larger bear market, which I see the second leg, which is a retrace, your B wave, if you will, taking us into 2023 before the final leg lower happens, probably taking us into the end of 2023, if not 2024. And now whether that happens or not is really not important right now. What's important is getting ahead of this next move. If the market is setting up to retrace back to 4,300 into early 2023, we want to be a part of that move. This is where you want to raise cash, get very defensive, right? And so this structure is what we're looking for. That would mean that this is a B wave. And once it bottoms, ideally above 3640 and turns back up, we expect a rally probably into the end of November, early December to take us into the 4050, 4150 range before a deeper retrace happens, taking us back into where we are likely right now. And that's where, the probabilities take us within the structure. The other scenario is what we want to call, or what we do call, a leading diagonal. It's still a five-wave pattern off the low, 1, 2, 3, 4, 5, but it's overlapping and messy. Now, these patterns are rare, but they do happen, especially as first waves in a bigger bull market that's forming, right? And so what we need to see happen is for this drop from the Fed high yesterday to not go much lower, and then to turn back up and go above 3912. And if we go above 3912, then we do have five waves off the low that's overlapping, and it could be a leading diagonal. Now, with leading diagonals, I would not buy this breakout. I wouldn't buy this breakout even if it's not a leading diagonal, because what's going to follow a fifth wave, that means that's the end of a bigger move and you have a deeper retrace. So we want to see how the retrace behaves. Is it a three-wave move that holds around a certain support zone? If so, we're going to buy heavily. But if we top out and then just break down in a five-wave pattern, then we're going to be adding significantly to our hedges. So we're kind of in a wait and see mode. We want to see how the market does react right now. But the most important thing is psychologically just getting these numbers off the screen. Keep this in mind. If the market does break above 39.12, what it's telling you, this is the first time that the Fed has spoken that we, saw a gap down immediately and the market just kept going down. So this would be the first time that the market retraces a Fed high after they attempt to throw cold water on a rally. And that's a very significant level. If that does happen, coupled with all these divergences that we got into last week, which we'll get into some in a minute, the market is telling you that it's discounting inflation, it's discounting the Fed hikes, and it's looking to go higher whether we like it or not. On the other hand, if we break below 36.40, we're going to start getting defensive. So these are the levels that matter the most. Now, if we move on to some of these supporting markets, I do want to point this out. The NASDAQ 100, we'll just kind of start there, which is predominantly tech, is currently about 2.5% from its lows, right? It's really weak. Tech is weak. A lot of high beta stocks. Some are actually looking relatively strong, like Netflix, for example, which is something we're buying pretty heavily around the 218, 215 level. But a lot of tech is looking like the NASDAQ 100. It looks like it's going to make a new low, or it wants to make a new low. Now, compare this with a stock like Caterpillar, which is a very important stock in the global economy. It's currently about 27% off of its highs and forming a really strong five-wave pattern. I mean, look at this breakaway gap. It didn't even come close to filling it, not even filling the top of it. So if we continue and push higher, then Caterpillar is telling you that it's putting in a major low right here in late September. And you got to think about what the implications of that for the global economy. And Caterpillar is a leading indicator for global economies. And so that's a really important signal. Also look at financials. Financials from a market cap perspective is relatively low, so it seems like it's not an important sector compared to, say, tech. However, it's extremely important. If you look back in history, the biggest bear markets, the ones that have given us the most problems, all have to do with the financial sector getting into a lot of trouble. And that is not happening right now. Anyone following bank earnings, shockingly bullish. They are thriving in this rising rate environment as the 30-year mortgage goes up much faster than the effects of the Fed funds rate is distributing it out into the economy. We're still seeing home buyers buy houses, and the money they're making off of those higher loans is more than compensating for losses in other areas of their business. And most of them are raising guidance into 2023. In fact, JP Morgan has $1.2 trillion in cash. I mean, that's not a typo. And so it's pretty hard for a bank to get in trouble when it has that much cash and that level of profit making on its books going into 2023. And it's showing up in the charts. XLF, I mean, this is showing you a 1, 2, 3, 4, 5-wave pattern that's developing. And unlike the S&P 500, look at this, 1, 2, 3, 4, holding above that level. And if it turns back above this level, then it's pretty confirmed that we have a 5-wave move off the low. And XLF can go as low as 32.85, 32.50, and still hold this structure. So the weakness we're seeing in the NASDAQ 100 and tech, which is carrying over in the S&P 500, is just it's not distributed equally across the markets. In fact, we're seeing these green shoots, these divergences that have us perking up right now. The last thing I'll show you in terms of divergences, this is a high beta ETF by iShares, MTUM, roughly the world that we track in, some high beta tech in here. And it has a pretty clear 1, 2, 3. This is a 4th wave and a 5th wave higher. If we get that 5th wave higher, which it looks more likely we'll get that than a break below 140, then we have another market confirming that that the broader market is looking to go higher. And so I just want to point that out. If we weren't seeing these divergences, we'd be quite cautious right now, especially after what the Fed said yesterday. but we're seeing many markets diverging. We're seeing rates not make a new high, the dollar not making a new high right now. In fact, the bond market is just right now not believing what the Fed was talking about yesterday. And so that's very important to us. And so just to keep it simple, above 3912, that's very bullish. It's the first time the market is taking back a Fed level below 3640 on S&P 500. It's time to start getting a little bit cautious. So we hope that was helpful this week. If you like what you are hearing and seeing, please sign up. I have a YouTube channel right here. We also have a institutional level research shop at the iofund.com, where we go through technical and fundamental analysis, both in the broad market and within a live portfolio in tech and crypto. So thank you very much and hope you have a good weekend.